Single factor fund is a specialist. I'm a Chinese specialist. That's what I'm going to cook. So you could have a low volatility single factor fund, a momentum single factor fund. It just focuses on identifying one kind of company.
Hello everyone and welcome to Learn with RG. I'm Avan Dabash and today I have with me Radhika Gupta, MD and CEO at Edelweiss Mutual Funds, and we're going to deep dive into smart beta passive funds. And I read somewhere that it's basically passive investing on steroids.
I think it's important to understand, when people use this word smart beta, it's been thrown around a lot. What's the difference between beta, regular beta, versus the smarter version of beta? And if I give you a simple example, a regular passive funds, and we've talked about passive funds in multiple episodes, say like the Nifty 100, it's taking the top 100 stocks in India based on the weights of by market capitalization. So the top 100 stocks based on a simple factor, and that factor is the size of the company. So the top 100 companies by size are put into the Nifty 100. So that's regular beta. Non-smart beta, regular beta, whatever you want to call it. Now let's add the passive funds on steroid. The same fund, if the chef here were to say, instead of choosing all those companies basis their size, I'm going to choose only the top 50 companies that meet a certain criteria. And that criteria is quality. I'm only going to choose the companies that meet the criteria of quality. Quality in this case is the factor. So smart beta funds are also called factor-based funds. So I'm going to pick this factor quality because I think quality companies tend to do really well. And from that 100, I'm just going to pick the 50 companies that are quality companies. These are the rules that define quality. Suddenly, instead of beta, it becomes smart beta. So think of the chef who's doing rule-based decision making, but he's tweaking it to just make the dish a little tastier.
Adding a little masala.
Adding a little, but predictable masala.
Yeah, exactly. And not maybe following the recipe blindly, I'd say. So lots of factors then that need to be considered in a smart beta strategy. Let's start off with value.
Yeah, and I think before I get to factors, I should say that none of these factors are out of thin air. These are all time-tested ideas. These are things you've seen your fund managers, people talk about in markets, on television. These are things that people anyway use when they look at companies. Now, value is something we've always heard about. I believe value is a good quality shopper. It's someone who knows how to buy something at the right price. So companies that are inherently decent companies but maybe trading at a discount to their fair market prices, think of it as someone buying a good quality watch on a bargain. And sometimes we do get bargains. That is value, and value has been a very popular style of investing, which is why it works as a factor.
And what about, log kehte hain momentum, quality?
So momentum is interesting, right? Because fundamentally, I think momentum is very close to us. I always say that, if you're choosing players for a cricket team, you like to bet on people who've been in form. Yeah. If you're choosing who to bet on in a horse race, you tend to look at people who've won past horse races. That is momentum. Over a 1 year period, 2 year period, 6-month people, it's people who are stocks that have been outperformers. So a momentum factor oriented fund would be biased towards companies that have performed well in recent times. And it's a style of investing we all anecdotally use in our life. Quality is, I call quality a good student. Someone who comes to class regularly, someone who's polite with their teachers, who scores well in class. I think in companies, the analogy is a company with sound fundamentals, a company that doesn't take on too much debt, a company whose financially sound company, a company whose earnings are consistently growing, a company whose return ratios, whose return on equity, whose return on invested capital is healthy. So a company with sound traditional financial metrics that someone would look at, just like the good student in class.
So we've discussed 3, but let's also discuss alpha and what the importance is when it comes to low volatility.
Yeah, so alpha is the it's the chase for people who will do better than the rest. So it is companies, again, typically over a 1 year period, that tend to outperform the benchmark. So it's students that tend to outperform the average peer group. Those would be alpha oriented companies. Low volatility companies, as the name says, are companies that don't give you too many ups and downs. So stocks that are not too volatile in their price performance. And why would you look at low volatility as a factor? You want companies that don't give you too much of a bumpy ride, so that there's consistency and smoothness in your investing journey. So all these five factors, whether it's value, momentum, quality, alpha, low volatility, these are things that intuitively make sense to you. We are just putting rules behind them. So value could be price to earnings, quality could be debt levels, low volatility could be standard deviation. We're just putting formula to 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 codify, common sense.
Yeah.
Formula to codify common sense.
Yeah, so let's talk about how to really use that formula, use it in practice when each of these factors would really come to the fore. So for instance, do you think that value would perhaps be there when there are economic recoveries?
Yeah, so value companies in general tend to do well in a period of economic recovery, because companies that are priced at a discount, to their fundamentals tend to catch up in this period. So generally, when there is a large economic recovery cycle, you'll see what you call traditional value stocks do well.
What about momentum and quality?
So momentum and quality are a little different. Quality, I think, is a little timeless, because financially sound companies tend to do well all the time. All the time, they may do less well than some of these value and recovery companies in an extreme bull market, but they tend to be all season kind of companies. Momentum tends to do well in extreme bull markets, and momentum tends to do well when there are large trends in the market. So if there is a big upcycle, the same companies continue to get money. People continue to bet on companies that have done well in the past. That's when momentum tends to do well, when there are big trends in the market. Low volatility, on the other hand, is the opposite. It tends to do well in economic down cycles or periods of tougher markets, where people tend to give preference to more steady and stable companies.
Okay, that's when those factors shine. Now let's go back to understanding the types of smart beta funds and talk about the chef examples, if you will. Someone specializing in a particular cuisine, you would put that down to single factor funds?
Yeah, so a single factor fund picks any of these. We talked about 5 factors. Single factor fund is a specialist. It says, I'm a Chinese specialist, that's what I'm going to cook. So you could have a low volatility single factor fund, a momentum single factor fund. It just focuses on identifying one kind of company.
Okay, and what about multi-factor funds?
So multi-factor funds is, and this cuisine is very popular in Bombay. It's trying to bring fusion together. So you remember in Bandra we see these dosas with noodles inside them. It's, I mean, I know you're making.
Some people like it,
Some people don't like it. Or the ephemeral Indian Chinese cuisine, Punjabi cuisine or whatever that is. But the idea is to combine two factors. So, for instance, you could combine something like Alpha, which are companies that have done really well in the last 1 year. Have outperformed in the last 1 year. But you could say, I'll also add low volatility. So I want them to do well, but I don't want ones that have been excessively volatile. So that then becomes a multi-factor fund, where you've taken one factor, combined it with a second factor to produce this sort of fusion dish, and that leads to different outcomes.
Okay, multiple factors, like a culinary master maybe. Now let's discuss, Radhika, choosing the right smart beta fund. What are the factors that you need to think of, like 1, 2, 3, what should we keep on top of mind?
So first, your own investment objectives and risk appetite are extremely important. And, sometimes factors, the good thing about factor driven funds is you can really tailor them to your style. So some people inherently are very comfortable with momentum. Some people are inherently, they believe in value as a concept, and then you can pick up factors that work for your style. It is also useful to know that if you look at a single factor fund, it tends to be a little more cyclical. We've talked about the fact that value does well in down, in economic recoveries, etc. If you pick up a multi-factor fund and you're combining alpha and low volatility, it will be a little less cyclical in nature because you're combining multiple kinds of things. So that's important. And I think when you study factors, it's important to look at a little bit of longer history to understand when the factor does well, when it doesn't do well, what kind of companies you're holding, because this is not magic. This is not a recipe to make money without any risk. So sometimes people hear words like smart beta, they believe it's magic. No, it's good investing principles codified into rules, and like any good investing strategy, it will have periods of doing well and it will have periods of not doing well. And as an investor, it's very important to understand that before you start investing.
So now that we've understood how to really choose the right smart beta fund, who is this suited for in terms of investors?
It's good कि आपने ये पूछा, because again you hear the word like smart beta and लोगों को लगता है let's just jump into this, and I don't think किसी भी चीज़ में jumping into anything blindly is a wise idea. I think I talked about the core satellite approach in one of our episodes on passive investing, and the starter index funds, first time investors, you start with your basic market cap based index funds, because before trying to beat anything, do anything on steroids, you want to meet the market. So your core starts with that. These are great satellite exposures. So say you've done a large cap, index fund to start with, you're comfortable, you've understood your equities, maybe you can top it up with a satellite momentum fund to get that extra, exposure, that extra alpha in bull markets. And you can start with a small allocation. As you've gotten comfortable with that factor, you can research other factors and add this to parts of your satellite allocation. But I would say understand, study, and take steps gradually. Use a core satellite approach. Start with satellite. As you get comfortable with the cyclicality of the factor, then you can add it to your core factor.
Okay, so getting more comfortable with the cyclicality, because that's the nature of it. Radhika, thanks once again for elaborating all of the details. I just want to sum it up so it's easier for our viewers. Smart beta passive funds essentially offer an interesting middle ground between traditional passive and active investing. Do remember, it is not a guaranteed path to riches. There are a lot of factors to consider: value, momentum, quality, low volatility factors. Do your research, understand the factors that are involved, and choose a fund that actually aligns with your investment strategy. So Radhika, thank you for elaborating those details, and thank you to all of our viewers. I hope this video really empowers you to explore the world of smart beta investing. Do remember to stay connected and follow us on the YouTube channel and on social media on Instagram, Twitter at Edelweiss Mutual Fund. Happy investing.
Subscribe to our YouTube channel, Edelweiss Mutual Fund, and click on the bell icon for notifications. Mutual fund investments are subject to market risks. Read all scheme related documents carefully.